It was supposed to be business as usual, but China struck back, and suddenly, the ripple effects are hitting American wallets, boardrooms, and futures. Tariffs, retaliation, supply chains under siege. The US economy just took a punch it didn't fully see coming. So, what's happening? Who's winning? And how badly is the US getting hurt? Buckle up. You're about to see the fallout in real time. Welcome to Union Division. Today, we're diving deep into a dramatic twist in the ongoing US-China showdown, China's retaliatory move, and why the US is already feeling pain. Let's unpack the what, the why, and the fallout, starting now. To understand the shock, we need to rewind just a bit. Over the last year, the US administration has sharply escalated tariffs on Chinese imports, in certain cases exceeding 145% in total levies. China has tried to absorb the pain, but on April 10th, it couldn't hold back any longer. It struck back, announcing an additional 34% tariff on US goods on top of existing duties. This wasn't a minor jab. It was a message. No longer will China just take these moves silently. US imposes tariffs. China retaliates with matching. Even higher, tariffs, supply chains wobble. American businesses, consumers, and markets feel the shockwaves. The global economy has always treated the US and China as co-anchors, highly interdependent, mutually entangled. Some even coined the term chimerica to highlight that symbiosis. Now that relationship is fraying. So what exactly did China do? Let's break it down. New tariffs on US goods. China imposed a 34% additional tariff on US goods from April 10th onward. That's on top of existing duties, effectively a doubling or more in cost for many US exports. Escalation in some cases. In certain categories, China threatened to push tariffs even higher, up to 125% in retaliation. And it has already blocked or restricted exports of certain goods and suspended trade relations with companies it deems strategic. Export control measures and restrictions. China also added export controls and bans on some commodities and tech goods, particularly dual-use items, aerospace, defense tech, and critical minerals. These moves aim to weaponize supply chains. Political signaling and diplomacy. Alongside economic retaliation, Beijing strongly condemned US actions, calling them unilateral bullying and threatening to fight to the end. In UN fora and bilateral statements, China is pushing harder on global narratives, claiming that the US is destabilizing the global economic order. This was not a knee-jerk reaction. It was planned, calibrated, and meant to sting. Why did China decide to retaliate now? And so forcefully? The reasons are strategic, economic, and political. 1. Defending sovereignty and leverage. China views the US tariff escalation as an existential threat to its economic sovereignty. By hitting back, Beijing is signaling it won't be pushed around, establishing deterrence. 2. Escalation as leverage. In diplomacy, escalation can bring your opponent back to the table. China hopes that sharp retaliation forces Washington to rethink, negotiate, or de-escalate. 3. Safeguarding its economic base. China's economy is under strain. Growth is already slowing. The domestic side is fragile, with weak consumer demand, a flailing property sector, and falling export orders. By striking now, China may attempt to re-stabilize morale at home, rally nationalism, and project strength. 4. Signaling to third parties. Beijing also wants to warn other countries. If the US thinks it can unilaterally pressure China, others may be next. This aims to inspire resistance elsewhere and shape alliances. 5. Reconfiguring supply chains on its terms. China has studied how global supply chains are shifting. It hopes that by controlling key raw materials, intermediate goods, and export controls, it can maintain leverage even as the world decouples. In short, China is betting that retaliation can sting the US, force dialogue, and reshape the landscape. Now the hard part, how is the US economy being impacted? The answer? Already in multiple ways. Let's walk through 6 key channels of pain. 1. Supply chain, disruption, and higher input costs. Many US firms rely on Chinese parts, intermediates, and raw materials. With tariffs raised and controls tightened, those inputs become more expensive or harder to get. Margins compress, production slows, and firms pass costs onto consumers. 2. Inflation and consumer pressure. Americans will likely face higher prices, especially for electronics, appliances, machinery, auto parts, anything with Chinese components. In a fragile economy, this hurts consumer confidence and spending. 3. Financial markets and investment sentiment. News of retaliatory tariffs triggered stock market sell-offs globally. Investors hate uncertainty. Rising risk premiums and capital flight put stress on equities, bonds, and credit markets. Corporate investment pullback businesses may delay expansion, capital expenditures, or hiring when the trade environment looks volatile. Some global firms might divert investment to other markets, e.g. Southeast Asia, to hedge China exposure. 6. Macroeconomic drag. Growth, interest rates, sentiment. Trade tensions exert negative pressure on GDP growth. The Federal Reserve may have less flexibility. Cutting rates to stimulate growth may exacerbate inflation. Confidence in the macro outlook erodes, leading consumers and firms to pull back further. Already, signs are emerging. Some sectors have reported softness in orders and inventory gluts. Analysts are revising US growth expectations downward. Let's anchor this in data and real firms. Agriculture. US farmers exporting soybeans, corn, and meat to China now face steeper tariffs. Because China was a key buyer for American agricultural exports, many farmers may lose revenue or turn to other markets at a loss. Aerospace/aircraft parts. Boeing and parts suppliers, many of whom rely on Chinese supply chains, may see retaliatory tariffs on aircraft parts, creating cascading supply constraints. Electronics/semiconductors. Many firms import components from China. With added cost and supply risk, product cycles slow, and consumers may pay more for phones, EVs, appliances. Machinery/capital goods. US heavy machinery, machine tools, and industrial equipment exported to China are hit directly. Tariff barriers impair demand and profitability. Food/consumer goods. Some consumer goods, furniture, clothing, toys, that depend on China for parts or finished goods, trade agreements, and infrastructure investment can accelerate that shift. 2. Strategic reserves and stockpiling. For critical minerals, inputs, and components, the US can build buffers or reserves to cushion supply shocks. 3. Negotiation and diplomacy. Look for trade truce, mutual de-escalation, or phased rollbacks. Restore channels for dialogue and mutual concessions. 4. Targeted relief and safeguards aid. Affected sectors, agriculture, high export manufacturing. Use temporary tariff exemptions or subsidies to reduce shock while preserving long-term discipline. 5. Regulation and industrial policy. Encourage domestic manufacturing, R&D in strategic sectors, semiconductors, battery tech, rare earth alternatives. Strengthen supply chain resilience. 6. Coordination with allies. Work with the EU, Japan, Korea, India, ASEAN to form trade coalitions or pressure Beijing collectively. Greater multilateral pushback can reduce bilateral pressure. 7. Monetary and fiscal flexibility. The Fed must carefully calibrate policy. Stimulus in weak sectors, infrastructure spending, and fiscal buffers may absorb part of the blow. To see how this battle unfolds, watch these key indicators. Trade volumes. U.S. exports to China/China exports to U.S. tariff announcements. New rounds or raises supply chain disruptions, shortages, delays, back orders. Corporate earnings in export and exposed sectors, inflation reports, PCE, CPI, consumer confidence, and retail data, Federal Reserve decisions, diplomatic signals, meetings, summit communiques, reactions from third economies, EU, ASEAN, Japan. If trade volumes collapse or tariffs escalate, we may be heading to a harsher stage. If prices spiral upward, risk of stagflation looms. So let's bring it home. China's retaliatory move is no mere counterpunch. It's a strategic escalation. The US is already taking hits through inflation, disrupted supply chains, slumping exports, and shaken markets. We may be entering a new era of economic rivalry, one where trade becomes a weapon, supply chains are arenas of competition, and traditional alliances get tested. For those watching, the message is clear. Adapt, diversify, and don't assume business as usual will save you. In the months ahead, policies, diplomacy, and corporate strategy will decide whether this becomes a painful detour or a full-blown structural rupture. Thanks for watching. If you want to understand how China is changing the global economy, hit subscribe, like the video, and hit the bell, because we'll be tracking this fallout every step of the way. Until next time, stay alert, stay informed.